Okay, if you're feeling like the current market is a bit of a battleground right now, excitement over real regulatory progress getting hit by immediate macro fears, well, you're not alone. It's complex out there. And if you need the tools to quickly get a handle on these forces, this is your deep dive.
Yeah, that feeling, that kind of tug of war, it really stems from three major pillars impacting crypto right now, September 27th. And these aren't just, small headlines. These are big factors directly influencing liquidity, capital flow, and maybe most importantly for you, the overall appetite for risk globally.
Right, so let's unpack those immediately. We've got regulatory development, the rule book, essentially. Then institutional acceptance, that's the big money coming in.
Yeah.
And finally, macroeconomic indicators, the backdrop, the global environment for rates and risk.
Exactly. And our mission today is really to cut through that noise for you. We want to pull out the key news from those three areas, show clearly how they're having these conflicting short-term effects on, say, Bitcoin and Ethereum, and then pinpoint the longer-term trends and the metrics you really need to be watching to navigate this period of consolidation.
Okay, let's start with the bedrock then. Regulation. The U.S. is definitely making moves. And it sounds like the CFTC is laying some crucial groundwork for how the market might be structured in the future. There's some talk about a new initiative, maybe flying a bit under the radar.
Yeah, and what's interesting is how specific it is. The Commodity Futures Trading Commission, the CFTC, they've launched this public comment initiative. And it's focused laser sharp on two really critical pieces, tokenized collateral and stablecoins.
Okay, hang on. Those sound technical, but you're saying they're fundamental for finance's future. Maybe break that down for us. What exactly is tokenized collateral? Why is the CFTC zeroing in on that?
Right. So tokenized collateral, in simple terms, it's about taking traditional high-value assets from the real world, think government bonds, commercial paper, maybe even potentially real estate down the line, and turning them into digital tokens.
Okay.
And these tokens can then be used to back up or collateralize activity within DeFi, decentralized finance. The CFTC is focused here because, well, it's basically the legal bridge. It's how big traditional finance players can safely and legally interact with crypto protocols. It's all about managing risk when you're talking about potentially trillions in assets moving from legacy systems onto blockchains.
Gotcha. So this isn't just bureaucratic shuffling. This is like defining the actual guardrails for institutional DeFi. That feels pretty critical. Does this momentum mean U.S. regulatory clarity is actually getting closer? Or is this just another, consultation round that could drag on?
Well, it does suggest a real trajectory, both politically and economically. If you connect this to the bigger picture, there's definitely momentum, especially with all the talk around the potential passage of the Genius Act. That particular act, which seems to be getting priority under certain administration viewpoints, is really central to putting digital assets on solid legal ground in the U.S.
We hear that bill mentioned a lot. What exactly would the Genius Act clarify that the current kind of messy U.S. framework is missing, particularly on enforcement?
Yeah, the current situation is, let's be honest, pretty murky on jurisdiction. Who regulates what? The Genius Act really aims to clearly define certain digital assets, especially some stablecoins, as specific payment instruments, not necessarily as securities. And that's huge, because clarity there would essentially pull stablecoin issuers out of the direct line of fire from, say, the SEC regarding securities laws. It just removes that enforcement uncertainty, which is probably the single biggest hurdle for really large-scale institutional adoption right now.
And the practical result of that legal clarity would be, well, massive, I imagine.
Oh, absolutely. Stablecoins would likely be cemented as the sort of global backbone for really efficient cross-border payments, maybe even retail transactions. They're kind of where the digital dollar meets the real world, right?
Yeah.
Offering huge efficiency gains over the old, slow, expensive banking systems. Clarity is the key growth driver there.
Okay, so U.S. clarity would be a huge boost. But it's not happening in a vacuum. While the U.S. is consulting, Europe seems to be signaling maybe competition. The European Central Bank just put out findings from its digital euro innovation platform. That sounds like a serious signal about their own CBDC plans, right? Central bank digital currency.
It does, and it brings up this really interesting duality. Collaboration versus competition. On one hand, the ECB's move validates the underlying blockchain tech, which is fundamentally good for the whole industry. But on the other hand, a centrally controlled digital euro could potentially eventually compete directly with existing decentralized stablecoins for everyday use. It really all depends on how the ECB designs the final rules, especially around consumer access and, crucially, interoperability with public blockchains.
Doesn't that risk kind of undermining the clarity the U.S. is trying to build? I mean, why try to clarify stablecoins in the U.S. if a huge market like the EU is simultaneously building what could be a direct competitor?
Well, it certainly creates some geopolitical friction, yeah. The U.S. clarity, if they achieve it, is fundamentally about leveraging the dollar's dominance through regulated dollar-pegged stablecoins. Exporting that influence, basically, the ECB's digital euro, that's much more about maintaining monetary sovereignty within the Eurozone. So now you have these two giant financial blocks essentially in a race. Which form of digital currency wins the global payment rails fight? Decentralized stablecoins or centralized CBDCs. But interestingly, that race itself provides a massive tailwind for blockchain technology overall, almost regardless of which specific structure comes out on top in the end.
Okay, so regulation is the long game, the foundation. Let's switch gears to the immediate market action, that punch-counterpunch we mentioned. We've got this fundamental institutional buy-in happening, but it's clashing with immediate macroeconomic fear. It really is a case of conflicting signals.
Absolutely. And the institutional endorsements, they aren't just big. They're sort of game-changing in validating the industry's maturity level. We saw some really specific examples, right? SoftBank, Ark Invest, publicly increasing their involvement with Tether. And this isn't just like small venture capital stuff. This is major global finance stepping in.
What does that signal, though, beyond just a big check being written? Why is that specific endorsement so important for the wider market?
Well, it signals that institutions are starting to see stablecoins as vital, potentially interest-bearing money market tools, not just speculative crypto tokens. When giants like SoftBank put serious capital in, they're essentially endorsing the operational stability, the transparency, the regulatory standing of that underlying asset. They're signaling that, hey, stablecoins are now viewed as a critical part of global treasury management, cash positioning. That gives immense credibility to the whole digital asset setup.
Right, but that institutional confidence ran straight into a macro speed bump, didn't it? What was the specific economic data point that gave the market the jitters this week?
Yeah, it was the U.S. personal consumption expenditures data, the PCE inflation number. It came in at an uncomfortable 2.7% year over year. Now, this is the Fed's preferred inflation gauge, right? So a higher than expected number like that, it immediately triggers market anxiety. The market reads it pretty simply. Sticky inflation means the Fed might feel they have to keep monetary policy tight for longer, maybe delay those rate cuts everyone's hoping for, and that expectation just tends to crush risk appetite across the board, especially for growth assets like crypto.
So it sounds like Bitcoin is kind of acting like a rock in a storm, not sinking, but not really going anywhere either. Is that a fair way to think about this narrow, consolidating range?
That's actually a perfect metaphor for Bitcoin right now. It's really caught in the middle. The macro fears, the rate anxiety, that's definitely pulling it down. But then that institutional support we just talked about, plus this underlying belief in BTC as a kind of macro hedge, that's providing a pretty strong floor, stability. And that tension is exactly why it's expected to move in this tight range. Investors are clearly nervous. You see it in the Fear and Greed Index sitting squarely at 33, which is labeled fear.
Okay, and what about Ethereum? We talked about the CFTC focus on tokenized assets being structurally good for ETH. Does that regulatory tailwind sort of win out over the immediate macro fear for Ethereum?
Ethereum, yeah, it could potentially react a bit more positively precisely because of that regulatory angle. The CFTC looking closely at stablecoins and tokenized assets, that's a direct fundamental plus for Ethereum. I mean, the network is the primary layer for stablecoin issuance and most DeFi activity, right? It's unchallenged there. So any regulatory clarity around using tokenized assets legally on a blockchain is basically like an investment in the Ethereum ecosystem's future.
But it's interesting, Ethereum is still seeing outflows from its ETFs, even with this positive regulatory signal. Does that suggest maybe institutional investors are a bit slower to react to regulatory news for ETH compared to BTC?
It could suggest that, yeah, but you have to look closely at the numbers. Spot ETH ETF outflows were about $796 million in the past week. Now, that's a big number, sure, but many analysts are actually looking at it somewhat optimistically. The thinking is it might signal that the worst of the initial kind of forced selling pressure after the ETF approvals, that might finally be easing off. So if that selling is exhausted, then any good news that comes along like this CFTC focus has a much better chance of actually driving a recovery.
Right, makes sense. So finally on this section, let's quickly pinpoint the altcoin sectors. Who benefits most from this specific mix of macro fear and regulatory signals?
Yeah, you can see some clear potential winners here. The DeFi sector in general, obviously. specific stablecoin projects, the ones benefiting directly from this clarity discussion, and especially that real-world asset sector, the RWA space. I mean, their whole model relies on the successful use of tokenized collateral. Conversely, you'd expect the highly speculative alts, the ones with weaker fundamentals or maybe lots of leverage behind them. They'll likely face continued selling pressure. Investors are probably going to seek assets with more solid foundations when there's this kind of macro uncertainty hanging around.
Okay, so if the market's caught between this institutional belief and global macro fear, where do we look beyond the daily headlines? Where's the objective data that tells us who's actually winning this tug of war?
Right. This is where we need to pivot a bit. Let's focus now on the key technical metrics, the ones you should be monitoring right now to really assess market health and maybe get a sense of future direction. These indicators, they try to strip away the emotional noise and just show us what capital is actually doing.
All right, let's start with that emotional barometer. We mentioned the fear and greed index. We know it's at 33, fear. But what's the strategic takeaway there for the long-term learner, for you listening?
Well, when the index hits 33, fear, you kind of have to remember what that often represents. It can feel like, being in a crowded room when someone shouts fire. The crowd tends to overreact emotionally. So extreme fear often suggests investors are maybe capitulating or just overreacting to the negative news. For a strategic learner, someone thinking long-term, this implies the market is currently being priced by pessimism. And that often creates a classic value opportunity or maybe a buying opportunity for those who are willing to take a contrarian view, assuming, of course, their own fundamental analysis holds up.
Okay, so track sentiment. Next, let's track the money flow within the crypto world itself. How is Bitcoin holding up compared to everything else?
For that, we look at BTC dominance, or BTCD. Right now, it's kind of bouncing between 57.8% and 56.4%, and the interpretation here is really important. A rising dominance number suggests capital is actively flowing into Bitcoin. It's being treated as the main relative safe haven within the crypto market itself. That usually signals caution, risk aversion among crypto investors.
So if we see BTC dominance staying high, sort of stuck in that range, does that mean capital is just too cautious right now to really flow into the more volatile altcoins yet?
That's pretty much it, yeah. High dominance generally implies institutional or just large investor risk-off behavior within the crypto space. The moment you start to see that dominance fall meaningfully and consistently, let's say it drops below 55% and stays there for a bit, that's usually the signal. It suggests investor confidence might be returning, capital's flowing out of BTC and into alts. That often marks the potential start of a real altcoin season.
Got it. And finally, the crucial external measure, the flow of institutional money, which we can track best through the ETFs.
Right. And the trend here is maybe the clearest signal we have of what the big money is doing. We're seeing sustained net inflows into the spot Bitcoin ETFs. That confirms basically uninterrupted institutional buying accumulation. That's really the fundamental bedrock supporting the market floor right now. Conversely, while the Ethereum ETF outflows are shrinking, the fact there's still outflows means ETH hasn't quite secured that same level of consistent institutional buy-in that BTC clearly has established. So tracking the difference, the divergence between these two types of funds is critical for gauging that long-term institutional appetite.
And looking even further out, beyond this week's noise, what are the underlying growth drivers? The things that suggest we're still pretty early in this whole adoption cycle, regardless of the current volatility.
Well, the adoption curve itself seems to be structurally steepening. I mean, look at the number of public companies adding Bitcoin to their reserves, their balance sheets. It went from maybe one company to now over 75 in a relatively short time. That's a key indicator of corporate acceptance, maturity. Combine that with the longer-term trend of actual nations considering strategic crypto reserves, something we expect to see more of in the second half of 2025. You just see demand growing not just from curious retail folks, but on a global structural level. And that suggests real long-term staying power.
Okay, so that brings us neatly to the summary then. This deep dive really shows us a market that's locked in this consolidation phase. It's fundamentally weighing that structural regulatory progress, which seems to heavily favor stablecoins, and by extension, the Ethereum ecosystem against this immediate macro instability driven by that sticky PCE inflation data.
Exactly. And the key takeaway for you as you're processing all this and thinking about how to apply it really has to be focused on proactive risk management. Given how differently sectors are reacting, DeFi and RWA potentially benefiting while speculative alts might struggle, diversification seems absolutely essential right now. You really need to monitor those key technical support and resistance levels closely. And just know that Any official word, any announcement from the CFTC, the SEC, or the Fed, it has the potential to cause sudden, sharp moves that could override pretty much all the other indicators in the short term.
And as always, we want to leave you with a specific forward-looking thought, something based on upcoming events that builds directly on what we've just discussed.
Yeah, we're tracking two things pretty closely right now. First, watch the market chatter, the speculation leading up to the SEC's CFTC Harmonization Roundtable. That's set for September 29th. But pay close attention to the signals coming out maybe the day before, September 28th. The language, the rhetoric from the agencies, will it sound like they're preparing a unified, supportive legal front? Or should we brace for more turf wars, more antagonistic regulation? That could really chill institutional enthusiasm quickly.
Right, that makes sense. And the second thought?
The second revolves around the ECB. After releasing those digital euro findings, we need to really scrutinize any follow-up speeches from their officials this week. We're waiting for clarity on one absolutely vital point. Is the digital euro going to be designed to seamlessly interact with existing public blockchains and DeFi infrastructure? Or will it be designed to actively avoid them? That single answer could really determine the ceiling for crypto growth and integration across the entire European financial system. Food for thought.